Morning, market chameleons, and soon to appear Dmitry Pargamonic. How's everyone doing this morning? Wednesday. How you doing,
Good
D?
morning, Will. How are you?
Great. Good to see you, buddy. Let's get right to
Good
the
to see you.
disclaimer.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need, well, you got some stuff going on there.
Sorry, this disclaimer disappeared for a
Yeah.
second.
If you need professional help, call your broker. That's what they're there for, to help provide you with guidance, help answer your questions. There's the disclaimer.
Excellent. So what are you
Okay.
seeing this morning, buddy?
Let's take a look. Let me share my screen. We'll take a look what's going on in pre-market trading, and then I'll do something similar to what we did yesterday with Target. I think I'll focus on today a different stock and just kind of go through one stock. We'll pick out, a option strategy, look at that option strategy. We'll also analyze the stock from couple different perspectives, fundamental and from a fundamental perspective, and also from a statistical analysis using historical data. Okay, so that's what we'll do today, very similar to what we did yesterday with Target. So this is the pre-market report. We'll take we have stocks that are trading in a pre-market hours. We have the most active stocks here, biggest percentage gainers, biggest percentage decliners. Let's first take a look at what's going on in the higher market cap stocks. So I'm going to use this filter up here. We'll look at stocks with the market cap 20 billion or higher. So here we got 42 that made the percentage gainers list, 9 on the percentage decliners list. From that perspective, looks more like a bias towards the bullish side at the open. Just looking I'm just kind of going down the list, looking at the volumes here. The only volume that sticks out is Intel, trading 1.2 million shares in the pre-market hours. That's up 3.7%. Just hovering over the news, and it might be just rebounding from yesterday's sell-off. I don't see anything on the headline news, that could be making it go up. Let me take a look at the unfiltered report. So couple stocks here at the top of the list, lower market cap stocks, HOFV up 75.9% in the pre-market hours on 18.2 million shares, so very active. This is a $335 million market cap stock. Looks like they are getting into that something with NFT, right? Well, I'm just looking at the headline news here. Hall of Fame resort surges after announcing an NFT partnership with Dolphin Entertainment. So I guess they're rewarding that stock 75.9%. That's up to you to decide if that's justified or not. DLPN up 62.6% on 2.9 million shares. That market cap is 120 million. I'm going to hover over. Why am I seeing the same? Okay, so these two are related, right? HOFV, DLPN. And it's interesting to see if we're going to see that trend, all of a sudden in the morning, any type of stock that starts to announce a, NFT type of, getting into that NFT business. Are we going to start seeing those pops, right? So we see that kind of as investors transition. Remember, we saw that with blockchain. Anybody who said we're getting into the blockchain, you saw 60% pops in the morning. Eventually, that kind of went away. We saw that with COVID. Then we saw stocks saying that they're getting into the
EV space, yeah,
right. So anything
the weed stocks for a while.
Stocks, yes. So we'll see if that starts to pick up, and if investors are throwing money at it right now. But you see what happened in these two stocks, up 75%, up 62%. ALY, that's up 44.5% on 9.4 million shares trading in the pre-market hours. That's $137 million stock. That looks like it's up on an acquisition. So, just to save time, I'm going to move on unless there are questions in the pre-market hours. Anything, if you're seeing any questions on any of these stocks, let me know. Otherwise, I'm going to move on.
All right, move on.
Okay. So let's go here to the home page. And I'm going to take a look at, up here, we've got different tabs here. Got most active stocks by options. And then if you click through them, you could get some of these trade ideas that are getting filtered from our option screeners, from our different option screeners, and they're using our presets. If you want to go, you could go to the option screeners and use your own filter. So up here on the screeners, you got vertical spreads, single-legged options, butterflies, condors, straddles. So if you're looking for a particular strategy and you want to use your own filters, you can go there. These are being filtered out by our presets. Let's take a look at the bullish opportunities. Okay, so here what this is doing is it's looking at stocks that are shown from a technical perspective. They're moving in a bullish manner, and then it's filtering out trade ideas that have a theoretical edge. Okay, so we'll examine Procter Gamble today. I think we'll just stick with this stock. So there are two opportunities that it's scanned out in Procter Gamble. A bull put spread. So this is looking at selling the 132 strike put on April 1st expiration, buying the 129 put on same expiration, April 1st. As of yesterday's close, we haven't opened yet. As of yesterday's close, the market in that is a 70-cent credit, right? So you're selling a put spread. If you're selling a higher strike, buying a lower strike, you're getting a credit in a put spread, 70 cents. We think theoretically it's worth 50 cents based on historical stock behavior. That's giving you an 8.8% theoretical edge and a historical probability of success 77%. So I'm going to take a look at, we'll take a look at this bull put spread. On the flip side, there's another opportunity, that it filtered out. Let me close that. I just clicked on that report to give you more details, but another opportunity filled out bull call spread. So this is looking at April 9th expiration, buying the 131 call, selling the 136 call on April 9th expiration. Now you're buying a call spread, so it's a debit of $2.54. We think theoretically it's worth $2.74 based on historical stock behavior. That's a theoretical edge of 7.8% and a historical probability of success 61%. So let's do this. I'm going to first take a look at Procter & Gamble from a fundamental perspective. Then we're going to take a look at this strategy, the bull put spread strategy. Okay. So
sounds good.
Come back to what's that, Will?
I said sounds good.
All right. So I'm going to come back to this strategy and we're going to set this up in the options chain, analyze it a little bit further. But first, let's just take a look at Procter & Gamble. And the reason this one was also filtered out is because it's right now it's in a bullish, it made a bullish crossover. So the 20-day average, went above the 50-day average, 50-day average above the 250. But let's take a look at Procter & Gamble. So from the fundamentals perspective, let's take a look at a summary of it. I'm going to take a look at these tabs over here. So this summary, profit margins. So here are Procter & Gamble's profit margins compared to the rest of the market, which we're using S&P 500. So gross margins in Procter & Gamble, 50%. In other words, for every dollar it costs them to produce a product, for every dollar, I'm sorry, of revenue they generate from selling their product, it costs them 50 cents to make that product. So they keep 50 cents profit. So their gross margin's 50%. S&P 500, rest of the market is 32%. So from that perspective, their gross margins are above the S&P 500 benchmark. And we could see here, it's been pretty consistent, their gross margins. If we're going back, it was like 5 years of history, which that's pretty good. It's not jumping around. Net margins, that's after these, after their gross margins, if we take out all the other expenses, and what is left over to the shareholders, right? That's whatever other expenses they have with salaries and so forth. Net margins 18%. In other words, for every dollar they sell, for every dollar in revenue they generate from sale, they keep 18%, 18 cents remains that is available to the shareholders. So that compares to 9% versus the rest of the market. So there, that's two times, right? Two times what the market is. And we could see here it does jump around a little bit, but it's been as high as 23%, 16%, 5% at 18%. So that's still pretty healthy, though. I would say profit margins versus the rest of the market. Operating margin. So this is only looking at profits from their core business. So this will take out any type of, one-time sales or investments that they made outside their core business. Operating margins, 22% versus the rest of the market, 13%. So that's pretty good. And we see here that that's actually pretty consistent, right? Around between 20, 22%. So that, from that perspective, that looks pretty good. EBITDA, this is earnings before interest, taxes, depreciation, amortization, 27%. Profit margins versus S&P 500, 18%. So that's higher. We could see here that it jumped around a little bit, but it still looks like in the mid 20s, going from year to year. Fell here, started coming back. So as far as just profit margins go, and we compare it to the rest, they're pretty stable, and it looks to me like they are better. If we use the S&P 500 as our benchmark, they're better than the S&P 500. Let's take a look at their growth. How are they growing? So here, this is going to be revenue growth, net income, and operating profits, operating income. So their total revenue, here we see it's pretty flat for the 5 year. For the last 5 years, it's pretty flat. It looks like it took a big dip, and now it's coming back. So in the 5 year, it's flat, but if we take the 3 year average, looks like 4% versus S&P 500, 5%. But in the last year, it looks like they really outperformed the rest of the market. With the corona, it looks like the S&P 500 down 1% in revenue, Procter Gamble up 6%. Net income, it looks to me like they've been growing net income 10% on average year over year for last 5 years. Last 3 years, 11%. Last year was a great year for them. And this looks like that's been on that point, from that point of view, they've been executing pretty well if we use the S&P 500 as the benchmark. Operating income, so this is just profits from their core business. On average, in the last 5 years, 4% growth annually versus S&P 500, 3%. 3 year, 8% growth versus S&P 500, 1%. So we see it's accelerating. Last year, 16% growth versus S&P 500, down 12%. So we got two, so far we looked at two things. We looked at profit margins, look pretty good. Growth rates look pretty good. let's take a look at the valuation. How are they valued versus the rest of the market? So on evaluation, we're going to look at price to earnings ratio, price to sales, price to book. So price to earnings, if we took Procter & Gamble's market cap divided by its trailing 12-month earnings, it's trading at 23.4 P, 23 times its earnings. That compares to S&P 500 38. So here on a valuation basis, if we just compared it to the S&P, it's not valued as richly, right? And we could take a look here. 5-year average, P 34, 3-year average 39.9, currently 23.4. So if we look at these historicals, it's not, that valuation has not extended. And if we compare that to the S&P 500 5-year average, on a 5-year average, it traded at a 36% premium to the S&P 500. 3-year average, it traded at a 50% premium to the S&P 500. Right now, it's at a 39% discount to the S&P 500. So at least from a valuation, that looks pretty good. Price to sales. So this is its entire market cap divided by its trailing 12 months revenue, just total revenue. 5-year average, 3.9%. 4-year average, 4.1. Currently 4.4. So a little bit more richly valued there than the historical averages. But on a 5-year average, it traded at a 72% premium to the S&P 500. 3-year average, 68% premium to the S&P 500. Currently, we're at a 51% premium to the S&P 500, but you could see not as rich as historical. Last one, price to book. We're going to just take a look. I'm going to go through quicker because same idea here. 5-year average 5, 3-year average 5.6, currently 6.4. If we compared it to the S&P 500, it's kind of right in line with historical averages. Lastly, I'm going to take a look at the yields, and then we're going to take a look at what we think Procter & Gamble's fair value or implied value could be. Earnings yield is if you bought all the stock, right? If we bought all the stock in Procter & Gamble, bought the entire company, right? Its market cap. And if we kept those earnings, right? If we kept the earnings, assuming like the last trailing 12 months earnings continue, what would that yield us, right? So let's say we bought it for whatever. If you buy it for 100,000, all the shares and its earnings are 10,000 per year, that's 10% yield, right? So what is its earnings yield? Earnings yield 4.3% versus S&P 500 2.6%. And we can see that that yield is better than its 5-year average, 3-year average, while in the S&P 500, that yield has fallen. Operating yield. So that's only coming from earnings only from its core business, 5.1% versus S&P 500, 3.7%. So it's kind of consistent with its historicals, while the yield in the S&P 500 fell, as interest rates went down, valuations went up, so that yield is down in S&P 500. EBITDA yield, 6.4%. Procter & Gamble, S&P 500, 5.6%. So that looks better from that perspective. And we could see on a 3- and 5-year average, that's better as well relative to the S&P 500. So at least there, we compare it to the benchmark. At least to me, it looks like it's better on all fronts. What do you think, Will?
Seems that way. We did have a question. Brad Moore was asking if you use other comparisons besides the S&P 500 when you're looking.
So yeah, you can. I'm just using, because it's Procter & Gamble, I'm using the S&P 500. But let's say if you were doing like some like Facebook or Intel, you could drop this down and say, NASDAQ 100. So this will then compare to the NASDAQ, or if you're like maybe Intel, you want to do just semiconductors, maybe here, you could go down here, semiconductors, so it just, you can change the benchmarks. The default is the S&P 500. but you can change the benchmarks. And maybe if it's a technology stock, instead of just S&P 500, maybe you say, okay, let me just look at like NASDAQ, the NASDAQ stocks, or the technology sector within the S&P 500. So that's a good question, but yeah, you can change it over here. Hopefully that.
Very cool.
Let's take a look at the implied value of the stock. So here, if we give Procter Gamble, if we take a look at their historical multiples, so on average, it's three-year average P ratio 23.9. If we use that as our benchmark, this would be the implied value. 3-year average PE, price to sales, 4.1. If we use that, that's the implied value. Same thing with price to book, price to operating income. If we go and compare that to the rest of the market right now, it's PE is 24.6, SPY 38. That's a 35% discount to the market. It's 3-year average traded at 10% discount to the market. If we use that as our benchmark, this is the implied value. So it just does that for each multiple. If we take the average of these implieds, get 136.59, market 132.6. So that's kind of in line, right? So it is kind of in line with its historical averages, 2.9% discount. Let's take a look at the comparative analysis, and hopefully I'm going to try to go this, I'm just looking at the time. I'm going to try to go through quicker just to get to that trade idea card. But what about forward looking? So that was using historical multiples. What about looking forward on forward earnings? So to do forward looking, we need to estimate what we think the revenue is going to grow, what we think the profit margins are going to be, and then we're going to use an input for risk, and then we're going to compare that to the S&P 500. So here, I'm going to go down to this calculator. First, we want to see, well, what do we think its operating margins are? So I'm going to just use the historical data and see as a starting point and see if that persists, how it looks. So Procter & Gamble operating margins last year, 22%. We see it's kind of consistent with the 3-year average, 5-year average. S&P 500, 11.5%. So I'm going to use those two as my initial inputs. Revenue growth. So we see that in the last 3 years, Procter & Gamble's growth on average year over year was 4%. S&P 500 in the same period was 4.3%. So let's just use that as our initial benchmark. You could see though in a 5-year, 1 year, it's different. So you might want to start changing it around, but let's just use that as our initial starting point. Volatility, we see that the volatility in Procter & Gamble and SPY is very similar. So we use volatility because if we have two different assets earning the same amount, but one asset is more volatile. So when the market goes down and one goes down by 10%, while the other one only goes down by 5%. So obviously, if you're making the same amount, the one that goes down by less risk is more attractive because you got twice as much risk on the other one. So we'll use the volatility as our risk. So let's see how this looks. So here we go. If we use S&P 500, we bought all the stock, $36.1 trillion market cap, trailing 12 months earnings, 12.2 trillion. Procter & Gamble, market cap 326 billion, trailing 12 months revenue 74 billion. These are trailing 12 months revenue. So if we give a 5-year growth estimate, if SPY revenue grows by 4.3% per year, like we had in our calculator, next year the revenue would go up to this, the following year to this, and so on for the next 5 years. If from their revenue, 11.5% of it ends up being profit, operating profit, and this is year 1 profit, year 2, year 3. So cumulative profits the next 5 years, 7.9 trillion. If we paid 36.1 trillion for all the stock today, made 7.9 trillion, that's a 22% return. Procter & Gamble, if we use 4% year over year growth and a 22% operating profit, same comparison. At the end of 5 years, the cumulative profits are 91.7 billion. If we bought all this stock today for 326 billion, that's a 28% return. So here's the comparison. So what would Procter & Gamble be worth, implied value, if we just equaled if we priced it at the same benchmark as the S&P 500 for 22% return? That implied value is 169.04. It's trading 132, 21% discount. So again, these are only using assumptions and estimates to kind of gauge where it is versus the market benchmark. Okay. Of course, you could change these in a calculator. Maybe you think Procter & Gamble won't grow 4%. If it grows 2% per year over year, you recalculate it, then it's a 16% discount. So again, this is based all on just assumptions. We don't know what's going to happen in the next 5 years, just to get a sense of, where we think it is versus the rest of the market. Let me go back. If there are no questions here, I'm going to now go back to the Procter & Gamble and look at that trade card. So at least from that perspective, sorry, what's that one?
Oh, someone had a question about Cummins CMI. You can't compare individual stocks to fundamentals yet, correct? You can only compare it to the index.
Yeah, right now it's compared just to the index itself, but there is a tool right now we're building where it's going to allow you to compare it to peers. So instead of just a benchmark, you could just, let's say you want to compare Tesla versus General Motors versus Ford, you'll be able to do that as well. Like enter up to 5 peers and run a different report to make that comparison. Right now, it's just looking at, trying to look at more of a index benchmark or a market benchmark.
Perfect.
Benchmark. Yep. Procter & Gamble. So we looked at it here. We looked at it from a fundamental perspective. Let's just take a look at, here's a trade card. And it gave us this bull put spread. I'm going to go to this. I'm going to hit it on the options chain. It's going to take us to the options chain so we could analyze it further. I'm going to go a little bit quicker because I'm running out of time, Will. But it populates the legs for us here, selling the 132 put for $1.20, buying the 129 put for 50 cents. I'm going to load that strategy. This is what the payout diagram looks like at expiration. All right. So this is what it's telling us. The 132 put selling at 120, buying the 129 put at 50 cents, right? 120, 50 cents. So we could see here that if you did it on the bid to offer, that's 70 cents credit. Midpoint is 80 cents. So this is also important because, that's 10 cents difference between the midpoint of the market and if you just did a bid to offer. So keep that in mind. You want to get your execution as close to the midpoint as possible because this is a $3 put spread. So look, you're risking $230 if it goes against you, market falls. So for that 10 cents, extra 10 cents, it's about another 4% fee you're paying to get that execution. And 4%, that adds up, right? Think about it this way. This spread has 7 trading business days. So 4% is a big deal when you're looking at a 7-day strategy, right? If you think about it, how that would compound 4%, 4%, 4%, 7 days. That's a big deal. So keep in mind on those executions, where's the midpoint versus that's the liquidity of the market versus where the bid and offer is. Before we analyze this a little bit further, let's just take a look here at these statistics here. So we know there's 7 business days to go. Expiration's April 1st. Okay, April 1st, 2021. So from a seasonality perspective, we see historically between March 21st and April 1st, that stock using last 10 years was up 66.7% of the time for an average return of 1.6%. So at least from a seasonality perspective, it looks like a little bit better than 50-50, from that viewpoint, didn't tend to be a weak seasonal period, not significantly strong, but a little bit better. We also know that there's going to be 7 days of trading in this stock between now and expiration. So 7 full days. So what tends to happen over 7 days in Procter Gamble? Because as you stretch out the days, more things come into play, right? Like, the natural flow of money from pension funds, mutual funds, inflation. So what tends to happen over a 7-day period in Procter & Gamble? So if we look at that over 7-day period, 59.4% of the time, the stock is higher for an average gain of 0.4%. So again, using those statistics, that looks like, if we're just looking at it from, is it going to go up or down? It looks to me like it's more likely, up than down, just using those. You also have to take into consideration any type of news or events coming out as well, and anything could happen. We're just looking at it from a historical perspective, right? This doesn't mean it will happen. We're just looking at the data, what tended to happen. And it's in a fast bullish crossover. So we looked at 2 things here: fundamentals, statistical analysis, looks good. Then we get this put spread. And this put spread, again, if we took historical data and we ran this similar strategy with the strikes, same distance away from the spot price, 7 days to go. We used 4 years of data. We adjusted it. If it didn't have earnings, we took out earnings. If it had earnings, we put earnings in. We adjusted it for the implied volatility. So we put this into our model. At the end of 7 days, on average, that spread was, end value was 51 cents. Right now, the market's 70 cents, 90 cents. So obviously 70 cents versus 51 cents. If you could sell at 70 cents, historically, average end value 51 cents. That's about 19 cents edge, right? And if historically you sold it 70 cents, 73.8% of the time, it finished lower than 70 cents, meaning you were able to buy back cheaper, resulting in a profit. So that's using the historical data. You could open it up here and kind of go through it, but I'm running out of time already. So if there are no last questions, I'm going to let everybody go.
Excellent job, D. That was the opening bell 2 minutes ago. Thanks for joining us, chameleons. D, great job as always.
Thanks, everyone. Have a great trading day. Stay safe out there. Hope to see you guys.